Welcome to Tech Talk Tuesday. I'm your host, Carla, and with me is my fellow co-host and CMT, David Blake. It's Monday, September 9th, 2024, and it was definitely a volatile week in the stock market last week, and we have some important things to look at moving forward. We do it mostly from a technical perspective. David, I hope you had a great weekend. How are you doing today?
I did. I'm in good shape today.
Awesome. Great to hear. Well, let's get started by taking a look at last week's market activity.
Okay, well, we did have a volatile holiday shortened week last week, despite on being we were down every day, especially with the S&P 500. At the end of the week, I think they said it was one of the worst week for the Nasdaq or for the overall market since early 2022. We had the Nasdaq down over 1,000 points. That's 5.8%. The Russell 2000 was down 5.7%. And we continued to have that rotation out of the Magnificent Seven and mega cap tech stocks, particularly technology and semiconductors, into more defensive areas of the market. That included consumer staples, utilities, and real estate, which are considered, and even healthcare did pretty well last week. That's they're more rate sensitive type of sectors, and basically we have large investors taking that kind of defensive positioning just in case we see further economic weakness going forward. Now, we did get kind of hit with a trifecta of weaker than expected jobs data. We had the JOLTS came out, I believe, on Wednesday, and that less job openings in July than estimated. And then we got the ADP employment data, and that was also below estimates. In fact, they showed the fewest numbers of workers added since January of 2021. So that caused another big drop in the market. And then Friday's BLS non-farm payroll also missed the mark, but it did see a little bit of a tick down from 4.3% unemployment rate down to a 4.2% unemployment rate. So there was a little bit of that gave people a little bit of hope. The fact that the jobs market isn't just falling out of bed; it's weakening, but it's remaining orderly, which is kind of important. And we also on Friday finally saw the yield curve normalize. Let me check to make sure that's still the case today, and it still is. Today, the 10 years at 370 and the 2 years at 367. So that's the first time that we've seen the yield curve normalize since July 2022. In fact, it's one of the longest periods in the market that we've had an inverted yield curve going back, I forget what they said, for probably 40, 50 years. So that was, we usually when that happens, it normally forecasts a recession, but it doesn't always do it. I think somebody once said that the inverted yield curve caused 6 of the last two recessions, something like that. So it can happen without a recession coming in. And at this stage, we're still looking for a soft landing. It's a little bit more iffy right now because of the weaker jobs data. We want to see if that can stabilize here going forward. Now, as far as I was talking about the semiconductors and technology sectors getting hit hard last week, the semiconductor index sank 12.2% in the week, which is that's pretty amazing. In fact, right now from the high over the summer, that index, the Philadelphia Semiconductor Index, is down 23.6% from its July high. So that's basically a bear market. So we want to kind of look at that just to see how we're going to go. And now, as far as the technical condition of the market, it did deteriorate last week. We saw the major averages break some support levels, but we were coming off an overbought condition. We had the SRO, the Market Edge S&P Short Range Oscillator, had topped out the week before at 7.99%. And when you get over 7%, I used to say historically it's actually over like 4 or 5%. But when it gets to 7, you really actually see some movement from the institutional investors. And that was just maybe a pre-warning that we could probably see some weakness coming in after Labor Day. And that's certainly what happened. There's a couple of good things happened, and I think that this is important to point out. For number one, we still have 67% of the S&P 500 stocks are trading above their 200-day moving average. So that's a sign that overall uptrend is still in place. So that's something that you want to keep in mind. And the other thing that you want to watch going forward here, and we'll look at charts on these in a little bit, is the fact that all the indexes held above their early August lows. That's important. And I think if you look at charts going forward here over the next week or so, I think you want to make sure that we hold that, which I think we will. And if we do, if you're thinking about buying this dip, you might give it a day or so here, although we're up almost 600 points today. Dow's up 1.5%. As we're getting ready, because we'll talk about this in a little bit. We have some more data, inflation data coming out. But as long as we stay above that August low, that keeps the uptrend intact. And I think that if you're looking to get into the market, I think if you give it a day here just to see how we hold up. If today's bounce doesn't hold, then we're probably going to go down and test those early August lows. But I don't think we're going to see it. Even if we end up just a little bit today, I think that's a sign that the lows may have already been in for this little bit of the cycle. We're looking for the 40-day cycle in the CTI to have bottomed either last week or may bottom this week, one of the two. So as we get closer to that, if we do pull back a little bit more, I think you can start to add positions. Remember that historically in an election year, once the election gets around here, the market you generally will finish up. So some of the other things that were okay. We did see the Dow and the NYSE hold above their 50-day moving average. That's good. We saw NASDAQ and NASDAQ 100 went below their 100-day, but they stayed above their 200-day moving average, which is a plus going forward. And then we did see the S&P 500 and Russell 2000 settle between their 50 and 100-day moving average. So again, with today's bounce, it looks like we may start to see a little bit more of an attack on some of those support levels that kind of gave way last week. So we want to keep kind of watch on that. So if you're trading the market, looking for signs to get in, again, as we recapture some of those moving average resistance lines now, as support becomes resistance once it's broken, then I think you can start to add the positions. And I think traders will be watching those moving averages for areas where they can certainly get in. Now, the VIX last week jumped up to, it spent most of the week above 20. I don't know whether it got over 25 on Wednesday or Thursday or not. I'm not sure. But if it did, I like to look at 25 above if it gets up to around 25 on the VIX and then starts to come back in. To me, I've noticed that historically that kind of is a sign that probably the short-term bottom is in. So that was another sign where we ended up at around 22. And I think today we're at down below 20 today. We're at 1980 right now. So that's another good sign that maybe traders are getting a little bit less anxious. Now, as far as breadth goes last week, mostly negative. NASDAQ AD line lost about 5,000 units, which was a pretty good hit. And they also had more new lows than highs, while the AD line was a little bit better than that, but it also made new highs every day, which shows that, as that rotation is still going on, we're seeing new leadership come out of the market. So just remember that with that pullback, people start getting a little bit nervous. But the S&P 500 on Friday was still only about 4.5% off of its all-time high. That's not much of a pullback. I mean, that's not a correction. The correction is 10%. So 4.5% from the all-time high, and then today we're up about 1.25%. So you're still less than just around 3% off of the all-time high. So we're a far cry from having a correction in the market. So what I want you to just going further here, if we sell off today, we could retest of the August low. I don't think it's going to happen now. It would have started to roll over already, and we're up 600 points on the Dow. So I think that we're probably going to end up with pretty good gains today. Now, as far as going forward, after last week's rout, we do have the upcoming FOMC meeting on September 17th and 18th. Market's still, kind of a coin toss whether we're going to get a quarter or a 50 basis point cut at that point. That's something, that's kind of, we probably will get the answer to that this week because we have the CPI and the PPI coming out midweek. Those are the last inflation reports that we're going to get for the next week's FOMC meeting. Now, those reports show the inflation is continuing to fall. Then you might get the Fed, cutting a half a point. If they come in line, kind of steady, then I think you're probably going to get the quarter point, which is what what we're going to see. We don't really, we can also look at Thursday's initial jobless claims, but I think the CPI and PPI will be a little bit more important after the three big jobs reports that we got last week. Okay, other than that, um, Friday we also get the University of Michigan Consumer Sentiment Index comes out. That kind of going lower and lower, which meaning investors are a little bit less certain. They don't quite feel as good about the market and the economy as they did earlier in the year. If we happen to see a bit of a rise in the sentiment index on Friday, that would be another good slowdown. That would mean people were thinking, okay, they're feeling a little bit better about the economy and all because of the rate cuts coming. That would be a good thing. Remember that with second quarter earnings basically almost done, 79% of the companies that reported beat earnings. That's very healthy. And we still have a few companies out this week. We have Oracle, I believe, after the close tonight. That'll be watched. And we have Adobe Systems, another big cap tech, reporting later on in the week. And then the housing market gets a report from Lennar later on. So that's kind of the lineup for this week. I would expect the kind of choppy trading in here because of people just want to make sure they know that they're it's almost guaranteed that we're going to get some kind of rate cut next week. I don't expect the Fed to surprise anybody and keep rates steady. If they do, we'll probably end up having a big sell-off. But they're gonna start to move. I think they kind of wish now they maybe inked in a quarter point in July, which didn't happen. But something's going to happen next week on the rates, and that should be able to keep this market give a little bit more of a boost going forward.
Well, you mentioned that the S&P short range oscillator by Market Edge topped out prior Monday at 7.99%. Can we take a look at a chart just to kind of see how that oscillator reflected on maybe the S&P 500 or SPY?
Okay, you can see that we were going kind of sideways on the SPY the week before. We had the big drop, there at the 1st of August, and then we bounced all the way back. When you have a snapback rally like that, generally you're going to get an overbought reading, which is what we had. All of a sudden after the bottom was in there and bounced off of the 200-day and all, it snapped back very quickly, and that causes an overbought condition, which means you need to consolidate some of those gains that happened over 2-week period or whatever. And so that's what we got. Looks just look at the chart. Looks like the SPY has retraced about half of what we gained. Go ahead, hit the Fibonacci thing up there at the top. Let's see if that's about right. As you can see, that's very good right there. We retraced just about 50% of the move from the August low up to the August high. So that's a good place for the market to find a bottom. A lot of option traders will look at use the Fibonacci numbers as an area of support. When it gets down to that 50, they'll buy the calls. If that 50% retracement doesn't hold, they'll buy some puts, looking for the market to go down to maybe to at least test the 61.8%. So that just shows you that for 50% retracement, we're not overbought anymore. I think on Friday the thing was somewhere around just a little bit above being flat. So market has room here. We've done enough consolidation over that period last week that it can handle some pretty good gains in here.
Great. Yeah, I can definitely see the short range oscillator accuracy on this SPY chart. So another thing that you mentioned that a few of the support levels were breached on some of I think it was S&P 500 and NASDAQ. Can we take a look at maybe also on this SPY chart here and just see the support level?
Change. So go ahead and take out the 21 on the SMA on the overlays and put in 100 there.
Okay.
And then down here the 200, make that a SMA instead of EMA.
Okay.
Okay. Now you can see right here, this is the S&P 500, the SPY, very close to it, came down almost to the 100-day moving average and pretty much stopped before it got there. And with today's action, where we're up 68 points, 1.25%, going to head back up. You probably will want to watch that to see if it's going to clear that 50-day moving average or not. I would expect to see it kind of waffle around that area until we get it till next week's FOMC meeting. Go ahead and look at the NASDAQ now, and you'll see where, because of this rotation out of the tech stocks, QQQ would be fine.
Okay.
Yeah, that's good, because that one did a little bit worse. Now you can see the QQQ went down almost to the 200. It broke below the 100. In fact, it tried to get up above there a couple times last week and couldn't do it, and then it rolled over. Didn't quite get down to the 200, which is actually good. That's actually a bit more bullish than just bouncing right off of it. If it gets close and you see buyers coming in to keep it from getting down that low, that's usually a bullish sign. And today with the QQQ, we're up about another 1.25%. So you're getting some buying. Let's see, the stocks, in fact, today you're probably getting some semiconductor. When you after a 23% move, yeah, we're up almost 2% on the semiconductors. So that's still leaving it in a bear market, but you want to watch that a little bit. If we get it's below its 200-day moving average. We don't have the stocks in here, but if you go to another chart and look at it and see it get above the 200-day moving average, that would be a good sign for the semiconductors. You want to see them get out of this bear market, because you do need that. You don't need them, especially to be the leader going forward. As long as we get this rotation into the financials and industrials and some of the defensive positions, the market can continue to work higher.
Well, that's definitely helpful to know. So, something that stood out to me was the fact that we saw momentum slow from a 6 on the momentum index the prior week to a 2 last week. This was interesting to me because I heard from several news sources that momentum was holding strong and that that would cause dip buyers to continue pushing the market forward. Yet, we can actually see that momentum slow quite a bit, which shows that maybe the media narrative may have not been so correct. How can we monitor momentum using technical analysis for, let's say, maybe the S&P 500?
At Market Edge, we do a little bit different, because what we do for our momentum index, a lot of people would just look at the RSI, or they'll look at 14-day RSI, or they'll look at maybe stochastic, something like that, or see, go to SPY again, SPY.
Right?
Now I'll put cursor down here on the 14-day RSI over here all the way to the right. Okay, and you can see where we are on that. That was at a 44. Now, Connie Brown, who is a big technician here, and besides being oversold and overbought, Connie Brown discovered with the 14-day RSI that when you have a pullback like what we had last week, if the 14-day RSI stays above 40, then that means that the uptrend remains intact. Now, on the other side, if it goes below 40, and then you get up to, and it can't get back above, like, say, 60, 65, then that means your downtrend is going to stay intact. In this case, we've had the upturn. It's come down right close to the 40 area, and now we're headed back up. So in her work, that shows that the uptrend is still in place here, and we could move further. But anyway, what we do also, the way we look at our momentum index, that's a proprietary thing that we have here. We take the lows from that previous August low, okay, and then what we do is we measure 8 or 9 different items to what is outperforming the Dow. In this case, off of those early August lows, the S&P 500, NYSE, high lows, and also the NYSE AD line and utilities are still outperforming the Dow. However, the Dow is outperforming the Dow Jones Transports, the index NASDAQ 100, the regular NASDAQ, and the Russell 2000. And because those 4 indexes are underperforming the Dow, then that means that that will weigh on our momentum index. You want to see in a market that's really strong, like with a lot of momentum behind it, you'd like to see those secondary indexes outperform the Dow. That means that your investors are taking on more risk. There's certainly more risk in holding, some of the NASDAQ stocks and NASDAQ 100 and Russell 2000. So if they're willing to take on more risk, That's good for upside momentum. That means that investors feel good about the market and about the economy, and they're able to put more more money into riskier assets, and that will increase the momentum. But in this case, we don't see that yet. We want to see off that August low. The Dow's up. As last Friday was up 4.25%, where the Nasdaq 100 and Nasdaq are only up around 3%. So if they outperform the Dow this week, then we'll see that momentum index from the market edge momentum index probably get back up around 4 or 5, showing that momentum is improving.
Okay. Wow. Well, that is extremely helpful information, David. We are unfortunately running out of time for this week, but is there anything else that you'd like to add going forward?
No, no. Again, the big things this week got the CPI, the PPI, earnings tonight from Oracle, Adobe coming up midweek. And then, leading up to the FOMC meeting this time, I think you're going to see a little bit more volatility, and that's because of the uncertainty of whether we're going to get a quarter point or a half point rate cut. The market hates uncertainty. You may get a little bit of action on Wednesday coming off of the presidential debate too. I don't know. A lot of stuff in the economy is a lot of times with the economy, it's not exactly the president's policies that make the big difference of whether you're going into a recession or not, but a lot of times it's what they inherit. And I think no matter who wins this coming election, you're probably going to see a slowdown in the economy, as we're already starting to see signs of that. So, but you might get some volatility coming in here on Wednesday morning after that debate. We'll have to see. But other than that, just look for some choppy trading. Again, for today, make sure that this market stays up. If it sells off at the end, the last hour or two, that's not a good sign. And that could mean that we're probably going to go down and get closer to some of these moving average support levels. Kind of watch that. If we stay up today, then I think that just keep that choppy trading going into next week.
Okay, well, thank you so much for all the helpful information, David. We do have to wrap up this week's Tech Talk Tuesday. We want to thank you to all of our listeners, and we will catch you guys next week.